Over the last year, the cash in your wallet has been quietly losing value against the global standard. This chart tracks the US dollar to Indian rupee exchange rate. From early 2025 to March 2026, the data shows a steep slide. Over this fiscal year, the currency took a sharp 11% drop, hitting an all-time low of nearly 95 to the dollar. A decline this rapid, the worst in over a decade, usually indicates that something is broken deep inside an economy. But the confusing part is that the Indian domestic economy is actually growing. Real GDP rose to about 7.3% last year. On top of that, domestic headline inflation sit comfortably at a very low 2%. The central bank even had a room to cut interest rates. With growth this high and inflation this low, the economic engine is running smoothly. The pressure is actually coming from outside the Indian borders. First is the foreign investor has been withdrawing capital at a record scale, selling off over $19 billion in Indian equities. Second is escalating geopolitical conflicts in the Middle East have triggered a profound shock to the global energy market. Because of that conflict, the price of Brent crude oil has consistently crossed the $100 per barrel threshold. Third, the United States imposed punishing reciprocal trade tariffs of up to 50% on the range of goods, which slowed the Indian export growth. Underlying these events is the fact that India relies on foreign imports for 85% of its total oil needs. To keep running, India must import crude oils every day. But international market doesn't apply the rupees, must purchase the billion of dollars. This creates a current account deficit where the cost of oil far exceeds the dollar brought in by exports. This chronic desperate need to acquire US dollar floods the market with rupees. Supply outweighs the demand, mechanically dragging down the value of domestic currency. To stop the free fall, the Reserve Bank of India, the country's central bank, stepped in as a market defender. They stated that by liquidating $21 billion of their own foreign exchange reserves, flooding the market with US dollars to prop the rupee. If you look back at this chart, you can see that when they deployed aggressive regulatory crackdowns at the bottom of the curve, they capped back for open foreign exchange positions at $100 million to stop speculative hoarding. They also banned rebooking of forward contracts, essentially stopping the traders who were trying to make easy one-way bets that the rupee would keep falling. These multi-billion-dollar interventions forced a brief rally, but they act like they stop the bleeding, but they do not solve the problem of oil dependency. If the Middle East conflict drags on and oil stays expensive, the current account deficit could widen up to 2% of GDP. That pressure could drive the exchange rate towards the 100 rupees to the dollar. On the flip side, if geopolitical tensions ease and oil drops back to $18 a barrel, the rupee could cover some ground into a low 90s. Regardless of which path it takes, India has an ultimate safety net, a 686 billion war chest in forex reserves. That deep stockpile guarantees of over 11 months of import cover, ensuring that the nation stays solvent and force the energy bills. While this exchange rate drop is painful for markets, these reserves prevent the situation from spiraling into a sovereign debt default. For our average customer, however, the consequences are immediate. A weaker currency means every imported barrel of oil costs more, directly driving up the local fuel and transportation prices. It also erodes local purchasing power, making imported goods like this year's consumer electronics significantly more expensive at a retail counter. It acts as a hidden tax on any family relying on the dollar to pay for international education tuitions or foreign travel. The pressing question is how long the central bank can afford this expensive defense before the government is forced to implement the sweeping structural energy reforms, because the value of resilience against an unforgiving global economy. Thank you.